We've got Mr. Rakesh Rawal, the CEO of Anand Rathi Wealth, joining us on the show. Mr. Rawal, thank you so much for your time. And despite a largely flat equity market during the quarter, AUM has crossed 1 lakh crore rupees. How much of the AUM growth was driven by fresh net inflows versus market appreciation? And how sustainable is this momentum going ahead?
See, there are two parts or three parts of AUM movement. One is what is the net money that you bring in fresh from customers. That's been in the range of 2.5, 3,000 crores per quarter. The second is the market increase. The index goes up by some percentage, etc., etc. Yeah, that's not done too well, which is fair. The third is what is the return that you can make for your client over and above the index. Yeah. So that has also worked for our clients. So, for example, in this quarter itself, the mutual fund portfolio that our clients are having, the index has gone up about 6 7%, whereas the mutual fund growth has been in the range of about 11 12%. Yeah. So, the value that you create, the net monies, and the market, three constituents are there for AUM growth. Fortunately, they've all worked for us in the last quarter, which is the constituent of the 20% growth. In terms of how do I see this in the future, I think that the markets which have been muted, you can't have muted markets forever. So, therefore, the growth of the markets is compressed. And somewhere, as the environment becomes better, that is going to spring forward. So, in the next 12 months, I expect the markets to really push the AUM forward. Our efforts in net mobilization continue to be high, and therefore we expect good net mobilization to come. And the third is the strategy that we follow with clients has been adding value over the last 10 years, 12 years. I don't expect that not to add value as we go along. So I see a very, very bright future in the next 12 months for the company.
Okay, that sounds very optimistic, Mr. Rawal, and you're seeing further increase and robust increase to the AUM. That sounds good. Let's talk about net inflows. They were at about 2,743 crores this quarter versus 13,447 crores for all of FY26. Is this a genuine slowdown or does it reflect the self-governance adjustments that you described on the last call? And how should we be reading quarter one inflows against this 1.2 lakh crore AUM guidance for FY27?
Yeah, so there are two separate questions. One is 1,20,000 crores of AUM. If we are at 1,06,000, and I just said that the market should be better. So, to my mind, there is very little threat to 1,20,000, and we believe that we should get there. As far as net inflows are concerned, see, net inflows are also subject to the mood of the client. So whenever markets are down, there is negativity in the world, the fear content is high, there is reluctance in the customer to invest money. Yeah. So whatever net inflows we get, we have to cross this hurdle of reluctance, persuade him to give money. Now, if you reverse the situation, if there is overall buoyancy, then my effort to get a unit of money from the client is far lower, right? And my result is far higher. So I value this 2,700 far greater than 3,500 in good times, because this is the base that when good times comes, the number of 3,500 will be crossed very easily. So when difficulty is high, I'm able to get 2,700 is equal to 4,000 in good times. Yeah. So there is no change. It is just that the times are a little tough. We are still getting very, very good net inflows and customer buying. And when times change, the momentum will be still better. Again, 1,20,000, I don't see a threat.
Understood. So that also sounds very positive in a directional sense. Mr. Rawal, how has the mix of equity, debt, and structured products evolved during the quarter, especially in a relatively range bound market as we've seen in the last 12 months?
If you notice, broadly, our ratios of our overall AUM have remained near constant, with close to about 27, 28% in structures, 15, 16% in other assets, and the balance in equity mutual funds. Now, various stages of the market, this ratio has remained the same. And that's because we are governed by trying to achieve an objective for the client of in the range of 14, 15% return, for which there is a, you know, common strategy of putting 65% into mutual funds and 35% into structures. So that hasn't changed. So if the method to get to 14, 15 hasn't changed, I don't expect the ratio to change. So the ratio being same is indicative that the strategy is largely being followed by clients.
Okay, Mr. Rawal, I've been looking at the numbers and something that really stood out to me is the employee expense. That increased 53% on a year-on-year basis, which is significantly ahead of the quantum at which your top line has grown. What has driven this? What has led to this? And by when do you expect the recent RM hiring to translate into meaningful revenue, and when should operating leverage start to play out?
There are two parts to it, and therefore, if you remove uh, the one-off on ESOP expenses, then our RM, the employee expenses are in line with the previous years, in line with the revenue growth. Yeah. So our profit growth without either the effect of the one-off revaluation of assets and the one-off cost of ESOP expenses, that profit growth is 24%. Yeah. Our revenue growth is 18%. So there is operating leverage already exemplified in whatever we are doing so far. So look at it minus the one-off entries. Yeah. The second thing is that, yes, over a period of the next 2 years, I think operating leverage will continue to give us some gain, beyond which we'll have to, beyond which it'll be more in line with revenue growth equal to profit growth.
Understood. And Mr. Rathi, you've also, pardon me, Mr. Rawal, you've also announced, a lot of other plans for the company along with your earnings. Can you give us a framework of the investment phase of the AMC, expected capital commitment, operating losses during the build-out period? I mean, anything that you can give to us directionally when you are looking to break even in the AMC business?
Firstly, the AIMs operate for about three and a half, 4 years, and their cost is built into the RM profitability. Yeah. So it is the RM and the AM together servicing a client, and therefore, together with them, all of them are profitable. When we promote an RM to promote an AM to an RM, in 90% of the cases, he's profitable in the first year itself. So I don't see there being a long period of gestation to cover losses of employment, which doesn't get covered in the first year itself. So I don't see that as an issue at all. Normally, when people get promoted, they make profits in the first year. May not make large profits, they'll make moderate profits, but they will be profitable in most cases.
Sounds good on that note. And Mr. Rawal, lastly, let's talk about your bottom line. The PAT growth has been 24% and it has outpaced your revenue growth of 18%. Should the market extrapolate further margin expansion from here, or are there investments in RMs like we've been talking about, international expansion and the new AMC business that could limit your operating leverage?
Well, I think that it will be moderate increase in operating leverage over the next couple of years. Uh, uh, that is not to say that, hey, Whatever growth opportunities that we will get, we will continue to pursue. But despite pursuing them, there'll still be some moderate increase in operating leverage.
Okay, we'll be watching out for that. And on that note, Mr. Rawal, thank you so much for your time today. Good as always to be speaking with you. Thank you so much.